want to talk to you guys also is about the FAANG group: Facebook, Apple, Amazon, Netflix, and Google. The reason I'm going to bring it to our discussion right now this morning is because not long ago, it was just last August, that the talk in the marketplace was which company first is going to hit $1 trillion in market value. And guess what? Last August, it was Apple. They went past the $1 trillion mark, and actually they reached as high as $1.1 trillion. Look how quickly markets change. From a discussion which company would be the first one to hit the $1 trillion market cap, now we turned 180 degrees, and at this point, the group lost between all these five names north of $1 trillion. This was the group that, by and large, was responsible for most of the market movement. In fact, in the last 5 years, that group alone averaged about 38% per year. As far as Apple is concerned, I think it's looking cheaper and cheaper by the day. Right now, they are selling net of cash at 9.6 times earnings or so. They have $25 per share in cash. That's $123 billion net of debt in cash. So if you subtract the cash from the price per share, you find out that even in today's market, the company is selling at just a little bit less than 10 times earnings. And the market as a whole, the S&P 500 sells right now at 15 times earnings. When you look at Facebook, this is a company that still grows at 30% per year in revenues, sitting on $40 billion in cash, no debt. Between all their platforms, the WhatsApp platform, Instagram, and Messenger, they have a reach to 2.6 billion users. The only other, sort of speaking, business that they have a reach of 2.6 billion is the sun and oxygen. Other than that, I think Facebook is hitting the numbers correctly. But if I'm to talk to you guys about Facebook and decide if they were deserving the 40% decline they experienced, I'm not so sure. I'll just be very cautious before jumping in because they have a lot of regulatory issues. Their spending is going up 40 to 50%. They're hiring people to be able to better police their platform, to try and stay away from hate speeches that come on their platform and many other unwarranted content. Personally, I have a problem with Netflix. And why is that? Other than the fact that they sell at about 66 times next year earnings, which I don't like, and the market sells at 15 times, they spend about $2.2 billion in negative cash flow to create all that content every 3 quarters or so. That cannot be good, number one. Number two, they sit on north of $8 billion in debt. Cannot be good. Number three, they are committed to spend over $18 billion on content in the next few years. Also, cannot be good. Let's talk about Amazon. The issues they're having is higher valuations and lower growth rates. Selling at 50 plus times earnings, next year earnings, and growing at 15% per year as far as revenues, and that is down from north of 30%. And if you look at just their e-commerce platform, they're growing at 11% per year. So the one company left in the group that I do like, in my view, is Google. And the reason I like Google is because, number one, they are down with the rest of the group just about 20%. They are selling next year earnings at 18.5 times earnings, still growing at 21% per year. 80% of their business is all search. However, they have many other businesses that the market is not valuing in the stock, such as their cloud-based businesses, their artificial intelligence businesses, the augmented reality businesses, and more importantly, Waymo, which is their autonomous driving business. Some people in the marketplace still say that the autonomous driving marketplace by 2050 will equal just about $4 trillion. We got good news today on GM, by the way, which has another big footprint in the autonomous driving. They are laying off 10,000 employees, they're shutting down 5 factories, 4 in North America, 1 in Canada. And they are doing it because the autonomous market, in their mind, is by far more important than combustion vehicles.
A lot of what you said was right on. On General Motors, I think my take is a little different. A lot of the factories are being shut down because more and more electric vehicles are coming in. And there's hundreds of less parts to produce and assemble in an electric car than there are in a combustion engine car. Therefore, they don't need the amount of space, and that's going to trickle down also to their suppliers, which are going to change dramatically. So I'm just a little cautious about General Motors. Apple, I just think that in the next year or two, you're going to see that stock go up a lot. I would like to talk about one of their suppliers, Lumentum, because Lumentum took a real hit, 46% drop in their stock price. Apple only represents about 33% of their business. In addition to that, they have some very interesting products. They do the chips that do 3D recognition, and so Apple is using those in image recognition. But some of their newer products, which are light switching devices and laser precision cutting, are some of their newer products, and that is a multi-billion-dollar business.
One of the reasons why we think that Apple can find a new support level at $165 a share is because when the first quarter of 2019 is going to kick in, I think a lot of the analysts on the street, in response to what you said, are going to readjust their unit sales numbers, and will then know a lot better what is the unit sales scenario with Apple.
Facebook, I just think they have a lot of trouble coming to them. Regulatory issues are underplayed in that stock.
I want to touch on the entertainment sector a little bit, referencing Netflix, as you talked about briefly, and Disney as well. Right now they have about 165 million subscriptions, about 60 million of which are in the US. If we take into account the fact that there's 325 million people in the US, they've got about 20% of the population currently has a subscription. So you look at that and wonder how much further can it really go? There's a lot more room internationally for them to grow. For them to justify these numbers, there's got to be some significant growth in the future, and I just don't see where it's going to come from. Then we look at a company like Disney that has $60 billion in revenue, and they're trading at about 16 times earnings. Disney is starting out Disney Plus, which is a streaming service to rival Netflix. And at the end of this year, they're going to be terminating their agreement with Netflix, so there isn't going to be any more Disney content on Netflix. In addition to Disney's own content, they also own Pixar Studios, they own Lucasfilm, they just purchased 20th Century Fox. So now they own Marvel Studios. PE ratio of 15 times earnings versus 66 at Netflix.
As far as Netflix, Bruce is absolutely right. Last quarter, they missed their subscriber growth by 1 million. We can already see that their growth is slowly coming off the peak levels that we saw before.
We talked previously about the yield curve and being fearful of an inversion leading to a potential recession. Possibility of that happening is less and less. That should lessen the pressure on the yield curve. So if we can maintain a good spread between the 10 and the 30, should keep us away from the fear of a recession.
In my view, the number one indicator of a recession is an inverted yield curve, where everything else doesn't rise to the occasion. We all know that recessions come and go. We will have a recession one day. We just don't know when and how deep or shallow is it going to be. The highlight of the week is that during serious market corrections as the one we are experiencing right now, please open your account statements, study your positions, and try to upgrade the quality of your individual investments into companies that in normal times are out of reach because of extended valuations. Not like in baseball, you do not need to swing every single time. Wait for better positions and opportunities to step in gradually to pick up good quality names.